Welcome to another tutorial video. This one is going to be about the topic that everyone wants to talk about, which is Twitter's looming buyout, or I should more accurately say leveraged buyout. And we'll be looking at the deal here and saying whether or not it makes sense, whether it's crazy, whether Elon Musk has any chance of actually earning a good return here, even though he's mostly doing the deal for non-financial reasons. So since everyone wants to talk about this, I figured it would be useful to take a look at the deal, but focus a little bit more on the financial aspects and the actual numbers as laid out in the deal documents. Now, to be clear, this tutorial is strictly about the financial aspects here. So I'm not going to go into the regulatory, legal, free speech versus censorship details or any of that. These are all interesting topics, but they're above my pay grade, and I don't think you're actually watching these videos to hear people debate whether Twitter should have more content moderation or anything like that. So we're just not going to go in that direction here. If you want this tutorial in writing and the Excel model and the supporting documents with everything highlighted, you can go to this URL on screen. That's mergersandacquisitions.com/Twitter-buyout. So you can just go there and download everything. I'm posting all the links there rather than in the YouTube's description below because there's quite a lot here to get through. I'm going to start by giving you a very quick answer about whether this deal works, and then we'll go through and focus on a few specific parts and highlight some details that other sources and analyses seem to be overlooking. A lot of the other commentary about this deal seems to be from people who did not actually read Twitter's filings or the deal documents, so I want to go into that in a bit more detail here. Now, to analyze this deal, we created a fairly simple LBO model. If you go down and do a quick row count here, it comes out to around 300 rows, which by standards of LBO models is not really that complex. It's just a cash flow model, so we don't have a projected balance sheet. There are a few optional things and bells and whistles here, like different scenarios, but on the whole, this is something that you could probably complete if you had a few days of time, you knew what you were doing, and you already had easy access to the data. The very short answer here is that I don't think this deal is completely crazy, but it is quite risky. And even if it does well, I think that Elon Musk will struggle to get the standard 20% internal rate of return or IRR target that most private equity firms aim for over a 5 to 7 year period. Now, of course, he might try to exit before this 5 to 7 year period and go public again in 3 or 4 years, as has been reported in press releases, and maybe he doesn't care about a 20% IRR target. So maybe this criteria doesn't actually mean that much here, but evaluated as a traditional leveraged buyout done by a PE firm, it's difficult to see how the math works well here. In the best case, if everything lines up, I think that he could perhaps get a 20 to 25% IRR if he aims for an exit in this 5 to 7 year time frame. The most likely outcome, though, is probably something in the 10 to 15% IRR range. And in the worst case scenario, I think it is possible that he could lose 90% or more of his invested equity in the deal and get an extremely negative IRR as a result. So I don't think the risk reward profile here looks great. Yes, it could do well, but this is not the type of deal where the upside case is a 50% IRR and the downside case is a 0 or 5% IRR, where it's just barely positive, you avoid losing money. I don't think it's anything like that. I think it's quite a bit worse overall. We'll get into the exact reasons why, but the short version is that each part of this deal has many different problems. So let's go through the list of problems and then let's go into them in a bit more detail after this. The first issue here is that the EBITDA purchase multiple is over 50x, which is far above almost any other social media or social networking company's current trading multiple. And even if you look at the projected multiple here based on consensus estimates, it's around 28 times fiscal 2022 EBITDA, which is extremely high in any deal and certainly in a leverage buyout. Now, we can debate the exact numbers here. If you look at Capital IQ, they come up with a slightly different number. They're saying 51 times LTM EBITDA, but it doesn't really matter. Other people say 40 or 45 times. These are all extremely high multiples, and that's the first and biggest problem here. The second problem is that Twitter's cash flows are spotty at best, and they are insufficient to cover the interest on $25 billion of transaction debt, let alone to pay for the principal repayments, because there is some mandatory amortization on this transaction debt. The transaction debt is very high on a forward multiple basis. It's around 16 times EBITDA. And I'm just going by the merger documents and the financing documents here. So the actual number might be more than this, it might be less than this, but if you count everything, including the margin loan, it is a very, very high leverage ratio. The third key problem is that for the numbers to work, Twitter's revenue growth or its margins would have to expand significantly. Just for some reference right now, if you go down and look at the company's historical numbers, growth rates have been sort of all over the place. They grew a lot in fiscal 2021, not so much in fiscal 2020. EBITDA margins have fluctuated a lot. They've been in the single digits, they've been negative, they've been over 20%, but in its most recent fiscal year, the margin was around 16%. Going forward, most analysts think that this margin is going to go up to 30%, which is what we've assumed in the base case scenario here. And then on the revenue growth side, if you assume growth somewhere in the teens, so let's say between 10 and 20%, you would have to have this pretty consistently over the next 5 to 6 years for the numbers here to work out, along with, as I just said, that rising margin. Now, it's certainly possible to achieve this, but I don't think it's all that common for most companies, so this is yet another challenge. And then the fourth issue here is that an M&A exit is not possible because the company would just be too large at that point. It might be worth $100 billion in terms of enterprise value. When you have an IPO exit, the multiple is much more uncertain. The timing is also more uncertain because Elon Musk and the other investors, if there are other investors, will have to sell off their stakes gradually over time. So this presents yet another challenge. And this one, I don't think I've seen too many people discuss. The standard assumption in LBO models, as you saw if you looked at the Financial Times Alphaville Twitter LBO model, is to assume that there is one simple exit at the end and everything gets sold. And I don't mean to pick on them. I think this analysis is fine for a very quick view of the deal, but I don't think it's really realistic to assume that a company with an enterprise value of 60 billion to 95 billion could actually be sold to another company like Facebook or Snap or anyone else in this market. We could keep going and talk about the margin loan and how it's secured by Tesla shares. And so there's a huge risk here if Tesla's stock price falls and there's a margin call here. Then there's the legal and regulatory side. I don't think the government is going to block this deal, but Twitter does have a huge range of ongoing legal issues. Then there are the employees. A lot of them don't seem to like the deal, so some key employees could leave. We don't know how many Twitter could afford to lose. On the other hand, the company is quite bloated and it is poorly run compared to other tech companies, most people will acknowledge. So maybe it's actually not such a bad thing if some employees leave, but not too many. We could keep going, but I'm going to go into the lesson plan here and now go through each of these topics in a bit more detail. We're going to start with the information sources and the approach to the model here. Then I'll go through the purchase assumptions and the leverage used in the deal. Then we'll look at the operating cases and scenarios. Then go through the company's cash flows and debt repayment and why these present challenges. And then look at the exit assumptions and the proper range of exit multiples to use at the end. So let's start with the information sources and model outline. The main sources here are Twitter's 10K, its Q1 earnings report, the merger agreement, and the financing description. And if you go to the link I displayed before, mergersandinquisitions.com/Twitter-buyout, you can get highlighted versions of all these. And I've highlighted the most important or interesting parts and the parts from which I'm actually pulling information here. So you can go through and look at this. I'm getting things like the share count, for example, from the actual merger agreement to be as accurate as possible. In the financing document, I'm taking all the loan information here. That's how I got to the $25 billion number for the loans. And then if you go to Twitter's 10K, a lot of the information about employees and their current capital structure and other information is shown there. The time required here really depends on how much you want to use the real documents and how much of an LBO model template you already have. I would say this might be anything from a few hours up to a few days. A few hours if you don't really pay much attention to the deal documents, and more like a few days if you do go through them in a lot of detail. If you have a template, as I already had here, then it's also much faster because you don't have to worry about formatting. You will have to change things and tweak things a little bit, but it saves you a huge amount of time if you have something like this already available. In terms of the model type, as I've suggested before, a cash flow only LBO model is the best here. A full 3-statement model really doesn't add too much, especially not for a company like this, where there is a huge range of possible outcomes. So I strongly recommend doing something like this and having some drivers for revenue, expenses, and cash flow, line items like CapEx and depreciation, for example, and then having a short income statement based mostly on what's in their filings, and then having some cash flow projections, but not necessarily a full cash flow statement. If you want to go beyond that, of course, a debt schedule is quite important in an LBO model, and maybe something like a net operating loss schedule could factor in, but I think most of the others here are unnecessary and are not really going to add much. So we do have an NOL schedule, and we do, of course, have the standard debt schedule with all the interest rates and all of that. But we're making this pretty simple overall, and that's intentional because I really want to focus on the drivers and the scenarios as opposed to a complex LBO model. Let's go to part 2 and talk about the purchase assumptions and leverage. So for the share count and options, as I showed you before, these come directly from the merger agreement and the 10K. We seem to have slightly different numbers than other sources. Our share count seems to be slightly different because we're taking it from the merger agreement, and Twitter has been repurchasing shares, so that might explain part of it. In terms of the rollover stake here, as you know, Elon Musk started buying up shares in Twitter before the deal was announced. And the actual stake comes out to somewhere between 9 and 10%, depending on whether you're looking at the fully diluted shares or just the company's common shares or basic shares. We don't know what his cost basis is, but I've assumed $35 here. And so the cost basis of this 9% or so stake is around $2.6 billion. We don't know exactly what this is, so this is very much a rough estimate. The reason why this matters is because in this deal, he's going to roll over the stake, which means that we can reduce the investor equity by around $4 billion at the per share purchase price of $54.20, which I have right up here. The leverage is exceptionally high at around 30x historical EBITDA and 16 times projected EBITDA. But I'm literally taking the numbers from the financing document that was filed with the SEC for the deal. And this is what they have. It adds up to about $25 billion total. So I'm taking everything from there. We have a term loan and a senior secured bridge loan. We have a $12.5 billion margin loan, and then another unsecured bridge loan here for about $3 billion. And in total, it adds up to the $25 billion. The debt terms are also coming from this financing document wherever possible. In some cases, I had to simplify or make guesstimates for things like the overdraw fee for the revolver, but others, like the undrawn revolver fee, the maximum draw for the revolver, the cash flow sweep for the term loan, the annual amortization for the term loan and the margin loan, these are all spelled out directly in the case study document. For the spreads, in some cases they changed over time, so I usually just took the midpoint or the average here to calculate these. With the spreads, I think one thing that's very important is that right now, this secured overnight financing rate, or SOFR, is currently very low, below 1%, but it is set to rise because interest rates are rising, so this debt will actually be quite a bit more expensive next year and beyond. One other thing I want to draw your attention to here is the treatment of excess cash. Twitter currently has about $6.4 billion of cash on its balance sheet, and I think it's pretty safe to say that that's far more than they actually need to run the company. Just for some context here, if you look at the company's total operating expenses, really cost of goods sold and operating expenses together, their cash balance is quite a bit higher than their annual operating expenses. So I don't think they need nearly that much. However, if you look at the sources and uses schedule, we are using only about $1.5 billion of this excess cash to fund the deal. If you use up too much of this excess cash balance, then what ends up happening in the model later on is that the company needs to draw on its revolver pretty extensively because they have around $720 million of debt amortization each year. So we don't think they can actually use all that much of their excess cash unless they want to build up a pretty substantial revolver balance and go far beyond the $500 million limit that the debt documents set for the revolver. So the bottom line is that we can assume some excess cash is used to fund the deal. We do still have the rollover of Elon's 9% stake, but I still think it's probably something like a $19 to $21 billion investor equity to fund this deal. If you go up to the sources and uses schedule here, we have an investor equity just above $19 billion. I think the financing fees and transaction fees might be a little bit low here. They come out to something like $250 million altogether, $265 million. It might be higher than this. It might be more like $500 million, $400 million, something in that range. So the investor equity here could be a little bit higher. The excess cash could be a little bit lower. So that's where I'm getting the investor equity being between about $19 billion and $21 billion from. Let's go to part 3 and talk about the operating cases and scenarios here. So our usual approach is to start with the consensus numbers for Twitter based on research analyst forecasts and then move up or down from there. Here, we've created cases for a margin focus, a growth focus, and then a downside case where nothing comes together that well. And the difference is that the user growth, the average revenue per user, and the margins here all differ between these different cases. Facebook, or Meta platforms as it's now called, is the best in terms of the total user count, the average revenue per user, and the margins. So all these other cases are essentially discounts to what Facebook has already achieved, and that's the basic approach here. Each case will also have a different exit multiple because generally higher growth companies tend to trade at higher multiples, and especially if Twitter is being taken public as the exit here, which seems like the only real possible outcome, then all else being equal, it should have a higher EBITDA multiple if it is growing more quickly when it goes public. So I have on this slide a summary of the different cases. If you want to look at them in Excel though, you can certainly go down to our assumptions. And I have some notes here on the daily active users, the average revenue per user, and then the revenue per employee, as well as the operating expenses per employee. And you can see how these assumptions come together to create some very different outcomes here. I also have some notes on the side about how Facebook has by far the highest average revenue per user at $41. Snap is more like 14. Pinterest is more like 6 currently. You can easily find some good analyses online that compare the average revenue per user for these different companies. And so that's how we can tell pretty easily, for example, that Facebook really is the leader when it comes to monetizing its users. With the different cases or scenarios here, I think the most important thing is that in the 3 main cases, growth, base, and margin, the EBITDA margin is quite different, but the actual EBITDA is fairly similar, 3.4 billion, 3.5 billion, 3.7 billion. So it's not really that much different between these different cases. It's much different in the downside case. And in this one, we only get to around half of these numbers, but the EBITDA itself is not really that much different, even though the revenue is quite different. The growth case obviously has the highest revenue. The margin case has the lowest revenue, except for the downside case. So the company focuses on different things in these different cases. The average revenue per user comes out to be quite different. But if the exit is being priced on EBITDA, that EBITDA figure toward the end is not really all that different. Of course, we'll apply a different multiple to it depending on the case we're in, but the EBITDA by itself is not all that different. And you can see my estimates for the likely IRRs here as well, but we'll get into that more toward the end as we go through the exit assumptions here. So the next point I want to cover is the cash flows and debt repayment. A lot of the commentary here has focused on Twitter's EBIT or EBITDA margins, which is fine, but the reality is its cash flow profile is also very important, and I don't think it looks particularly good when you remove the huge stock-based compensation add back and treat it as a normal cash expense. Let's pull up the Excel file to demonstrate what I'm talking about here. If you go and take a look at Twitter's cash flow, or its simplified cash flow here, initially its cash flow from operations and even its free cash flow historically looks okay, but a big part of why it looks okay here is that they have a huge add back for the stock-based compensation. Now, the problem with this is that stock-based compensation creates additional dilution because it creates additional shares and options for employees. And so if the company keeps issuing this when the leverage buyout has taken place, it's going to dilute Elon Musk's stake, and if anyone else joins him, it's going to dilute their stake as well. So our standard practice is to zero this out in leverage buyout models like this, and also DCF analyses and various other analyses, and to assume that no stock-based compensation takes place after, and that everything is just treated as a normal cash expense within recurring operating expenses. So this just goes to employees and is no longer in the form of stock-based compensation. When you remove this in the historical period, the cash flow looks quite a bit worse, free cash flow drops by quite a bit, and going forward, without this add back, I think the free cash flow numbers look a lot more challenging to make this deal work. Another issue here is that the company's CapEx is consistently above its depreciation and amortization, and they state explicitly in the filings that they expect between 900 and 950 million of CapEx this year, so it's not like it's going to go down anytime soon. If you take a look at these numbers historically, in each of the past 3 years, CapEx has been quite a bit above depreciation and amortization, and we don't really have a reason to think that that will stop going forward. So the bottom line is that if CapEx far exceeds D&A going forward, and we remove the stock-based compensation, this company's cash flows look quite a bit worse, at least if you focus on the recurring operational cash flows as we have done here. We're also being generous by not penalizing the company in the form of extra taxes on the stock-based compensation. We're essentially just assuming it shifts to higher employee salaries, but that may or may not be true in real life. So this is also quite a bit of a generous assumption. Another issue here is the interest costs. A lot of people have focused on the secured overnight financing rate and said that it's low right now, it's 0.5% or at least under 1%, but interest rates are rising. Central banks around the world, even the Fed and the European Central Bank, are now saying that they're going to raise interest rates. Some have already raised interest rates. And so over the holding period, we've assumed an average rate here of 2.5%. And what this means, if you do the math, is that you have well over $1 billion in interest expense. Some commentary, some articles have said that Twitter will have 800 or 900 million in interest expense once the deal closes. And I think these estimates are off by quite a bit. If we just go down and take a look at the model here, we have cash interest of 750 million on the term loans and senior secured bridge loan in the first year, 687 million on the margin loan, the 12.5 billion margin loan. And then we have around 375 million in cash interest on the unsecured bridge loan. Now, admittedly, if you go down, or you go to the assumptions rather, and you modify them, and you say the secured overnight financing rate is only 0.5%, then this looks quite a bit better. Then we have more like 562 million plus 437 million plus 315 million, but it's still well over $1 billion here. It's more like 1.3 billion. And so even with that more generous interest rate assumption, the bottom line is that this is within range of the company's projected EBITDA this year and also next year. Of course, it gets even worse once you factor in the amortization on the term loan and also the amortization on the margin loan. The term loan amortization is 1%, the margin loan amortization is 5%. Add up everything here, you get to about $2.5 billion in debt service versus fiscal 2023 EBITDA of 1.9 billion in the base case. So the debt service exceeds the company's EBITDA. That means that this deal is going to be even more dependent on the exit multiple because they're not going to repay very much debt principal over this holding period, except for small amounts on the margin loan and the term loan because those are fixed and set by the loan agreements here. The end result of this is that in a lot of these cases, Twitter has to draw on a huge amount of the revolver. So if I change the scenario here to the growth case, let's go down to the debt schedule and see what happens. You can see that the revolver here goes up to an astounding 6.5 billion by the end because its cash flow is so bad in this case. Another effect is that the company builds up a pretty substantial NOL balance of around 4 billion or so here by the end. This is because the interest expense gets so high that the pre-tax income turns negative and the company just keeps accumulating losses. And then other stats like return on invested capital, the leverage ratio, the coverage ratio improve by a whole lot less than you might expect as a result of this additional borrowing that's required. So if we look at return on invested capital here, it's very low historically, 1%, 2%, 3%. But then going forward, it doesn't really improve that much in this growth case. It goes more to the 1% to 3% range by the end. So it's not really much different from what it was historically. And I think that is going to make the exit challenging as well. Yes, the growth is higher, but for a company like this that is more mature when the exit takes place, metrics like return on invested capital and efficiency also matter in this context. So that's a little bit about the cash flows and debt repayment. Let's now look at the exit assumptions. Now, the truth is that no one could sell Twitter for $100 billion or even $60 or $70 billion to another company in 5 or 6 years. It's just not going to happen. Facebook would not be allowed to buy it. Companies like Snap or Pinterest couldn't do it and wouldn't be interested, and they would probably also be blocked from buying it. So the reality is that an IPO exit will be required, which means that Elon Musk will have to sell his stake gradually over time. It'll probably take at least 3 years. It could take a lot longer than that. With the exit multiple range here, it's useful to look at the multiples of comparable public companies, the company's historical multiples, meaning Twitter's historical multiples here, and then how Twitter's growth rates, margins, and metrics like return on invested capital change over time. So we selected these 8 comparable social media companies: Snap, Match.com, Facebook, Kakao in South Korea, Z Holdings, which is for Line and Yacht in Japan, Weibo in China, and then Pinterest and Bumble in the US. If you look at the multiples here, I have a summary in the slides, but let's just go up to Excel and take a look at these quickly. You can see the range of EBITDA multiples. We're talking about maybe 11x to 27 times, and then something around 10 times to 23 times. And then the revenue multiples go from around 4 to 7x and around 3 or 4x to about 6x in the forward period. Twitter is far above these in terms of EBITDA multiples and also in terms of revenue multiples. Now, admittedly, this is at the deal price. They would be lower if we assume no premium. So for example, if we set the premium here to 0, then Twitter's multiples look slightly more reasonable, although I would point out that they're still at the very top end of these ranges, certainly around the 75th percentile and sometimes actually above the 75th percentile and closer to the maximum of these ranges. So even without this deal premium, Twitter is still quite overvalued in my view. But I think it's easier to see what I'm talking about if you take a look at these multiples and growth rates on a graph. So I've plotted here what these social media public companies look like. The correlation isn't great. R squared is around 0.65, so there's something there, but it's not particularly strong. You can see Snap is at the top end of the set because it's growing the most quickly and also has the highest revenue multiple. Facebook, interestingly, is also along the same line, but it's growing much more slowly and therefore has a much lower multiple. If we put Twitter on this graph at the deal price, it is right here. So it is far above this trend line. It's growing between 15 and 20%, but it has a revenue multiple of between 7x and 8x. So it's quite pricey based on this graph. Now, if you look at the company's historical EBITDA multiples, which I've plotted right here, they have traded at some very high multiples in the past. So if you go back 5 years to 2017, yes, they did have some very high multiples, but they also had almost no EBITDA. They were just coming out of negative EBITDA for a long time around then. Since the company has turned EBITDA positive, they haven't really traded at or above this 50x multiple for quite a long time, or 52x, whatever it is. There was a period in 2021 when they did, but for most of the rest of this period, they were quite a bit below this 52x purchase multiple. So what all of this means is that we think an exit multiple close to 50x is implausible. Twitter is clearly a worse business than Snap, Pinterest, and some of the other high growth companies here. Now, its financial profile does improve considerably over the holding period. I'll change it to the base case here so you can see what I mean. Its growth does seem more consistent even though it's falling by the end, and perhaps more importantly, its margin is quite a bit higher, going up to about 30% by the end. So we think it is plausible that they could trade toward the upper end of this range of multiples. And so our assumptions here are that in the downside case, they go public at a 15x LTM EBITDA multiple. The growth case is more like 30x. The base case is 25x, and the margin case here is around 20x. So that is the range of multiples we're assuming. If you go down and now look at the results and the output of this analysis, let's just take a look at the sensitivity tables. The bottom line here is that in a lot of these cases, we don't really think that a 20% IRR is all that plausible. If you actually look at the math here and you factor in the fact that Elon bought his stake close to the end of 2021, the start of 2022, and this deal is going to close at the end of 2022, and you factor in all of that, and then you assume that it takes 3 years to sell the stake, and you factor in the multiple, the net debt at the end, all of that. Overall, we think the most likely outcome here is probably something in the 10 to 20% range. Yes, if they can get to an exit multiple of around 30x, potentially you could see more like a 20, 25, maybe even a 26% IRR, but we don't think that is all that likely. And in the downside case here, you can see that there is a pretty good chance that Elon Musk actually loses money here. A lot of things have to come together and various elements all have to perform well for this deal to work. What does all of this mean? I think Elon Musk knows that this deal is financially very questionable, and he's already stated that he's not doing it for financial reasons. He's doing it for various other causes, the societal impact, free speech, according to him, and so on. If you're worth $250 billion like he is, it's fine. But I think that the banks and the private equity firms backing this deal might not stay along for the ride if they start to have questions about it. I'd also point out that the margin loan that Elon Musk has raised against the value of his Tesla shares has a 3-year maturity, which is actually shorter than all the other debt that is being used to finance this deal. Also, I think it might be difficult to find other backers if he decides he doesn't want to commit 21 billion or 19 billion or whatever of his own net worth to funding this deal. So that's it for our quick version, or maybe not so quick version of this deal, because this video is actually quite long. But to do a quick recap and summary now, we started by going over the information sources and the model approach here. We're mostly using the deal documents and the company's filings. The model is fairly simple, about 300 rows in Excel, no balance sheet projections because we don't think they're necessary here. For the purchase assumptions and leverage, these mostly came from the deal documents. And the main thing here is that the multiple is extremely high no matter how you measure it. The leverage is extremely high no matter how you measure it. Yes, the rollover from Elon Musk and the excess cash help a little bit, but when the deal price is so high and the leverage is very high, the deal is going to be very, very dependent on the exit because the company is not going to be able to repay that much debt throughout the holding period. With the operating cases and scenarios here, we looked at these and used Facebook as the main benchmark for the highest average revenue per user possible. And then we created a few different cases based on different outcomes, where the company focuses more on growth versus margins. We also looked at a downside case where nothing really goes all that well. And the main conclusion here is that in the growth case and the base case, it's fine. The margin case is a little more questionable, and the downside case is basically a complete wipeout most of the time. With the cash flows and debt repayment, the short answer is that the company is going to struggle here because the interest costs and the debt repayment, the amortization, are both very high. They exceed the company's EBITDA in at least several of the years here. And really, until the company's EBITDA grows significantly, they're going to have a difficult time making much progress on the debt, except for the required mandatory repayments here. And then with the exit assumptions, we went through the selection of multiples and explained the justification. The bottom line is that we think it is highly unlikely that they're going to be able to sell the company for anything close to a 52x historical EBITDA multiple or even a 28x forward multiple. So we set the ranges here to be much lower to mostly correspond to the existing comparable public companies and also factoring in Twitter's trading history as well. Overall, I don't think this deal looks great, but I don't think it's actually as crazy as it might seem at first glance. I think there have been some other recent tech leverage buyouts that are actually much more questionable than this. It's just that they're lower profile. But hopefully now you know a little bit more about this deal, what the parties involved might be thinking, and how it might work or not work depending on how the company executes on its plans.